being recorded on Monday, June 26, 2023. Thank you so much for joining me. If you're new to the channel, make sure you subscribe. I don't want you to miss any of the great content that's coming up. Thank you. Now, in this video, I'm going to talk about why gold is holding up so well. And I know that for investors in precious metals, it doesn't feel like that because if you don't look at gold, the rest of the sector obviously is not holding up well. The rest of the sector still really in a bear market. I mean, we can debate that. Obviously gold's holding up really well, but the rising costs, the fact that we're in a secular bull market, so people don't care as much about silver and the miners. All these things are still true. But thinking about why is gold holding up so well, before I get to that, I just want to make the point that gold is holding up well. And so here we have a daily line chart of gold. Here we have the Fed funds rate. Here we have just a simple calculation of real rates. This is just the Fed funds minus the CPI. And then here we have the real 10-year TIPS yield. And so when real interest rates are moving higher, as you can see, generally that's not good for gold. I mean, real interest rates are the number one fundamental indicator for gold and precious metals. And gold and precious metals are inversely correlated to real interest rates. So real interest rates going up, usually gold, precious metals go down, or at least they don't go up during that time. Of course, there are a few exceptions. But nevertheless, gold is holding up really well because, look, you have these huge increases in real interest rates. Basically, I mean, we're looking at, the TIPS data doesn't go back far enough. But, I mean, it's arguably this is the second biggest increase in real interest rates, maybe in history, or at least the second biggest increase since this in the early 80s. And so what I've done here is I've highlighted, or I've marked with vertical lines, and I've highlighted the vertical lines show all the times, they show the end of all the Fed rate hike cycles. And here I've highlighted the yellow are basically points where gold was not rising while the Fed was hiking rates. So in other words, when the Fed started hiking rates, gold was not rising, it went down. Those are the points I've highlighted. The other times, here you can see, in the 70s and after 1980, here in the mid 90s, they were hiking, gold went up. Mid 2000s, people forget about this. They started hiking, what was it? Yeah, around here, gold went up. So all these times, all the yellow, those are the times when gold did not go up when the Fed was hiking rates. And so, obviously the result here and the likely result that's coming, different from these points, although this, was really close to, here, between here and here, that's when the Fed kind of had a long pause. But, nevertheless, the cuts turned out to be really bullish after this, just like they were really bullish here and here, and which I think they're going to be coming up, in the next 6 to 9 months or so. But just looking at it, I think part of the issue, you go back to the 80s and, even though they were cutting here and here, gold didn't do well because it was in a secular bear. And if we look at real interest rates were strongly positive. So, I mean, when if inflation is 5%, but you can get 7%, there's no need for gold in that environment. So this is completely different, than what was happening here and, here and here as well. And so, it remains to be seen how this, Fed cycle will end. They'll hike a couple more times. How long will the pause be, et cetera, et cetera. But you look at how much real rates have gone up here and here. I mean, gold is, only 8% off the high or 7%. I mean, it's held up really, really well. So enough of that. Let's get into some reasons why I think gold is holding up well. So I came up with 3. Leave me a comment. Let me know what you think. But, okay, obviously we're in this environment of negative real rates. I mean, not right now, depending on what you look at, real rates are, marginally positive now. So this isn't the 80s or the 90s when you're in a secular bear, as I said, when real rates are strongly positive. So, yeah, the hikes are basically, we're just about done. There might be 50 more basis points. And, the market knows that future rate cuts are coming. It's just undeniable. I mean, even if you're in a soft landing and inflation goes down to 2%, rates are at 5%, they're going to cut rates in that scenario. So the market knows their rate cuts are coming. And in a soft landing, by the way, gold will still go up, but it's just not going to go up as much in the other scenarios. So that's one. The second, there's a clear recession risk. I mean, even, I mentioned this in my premium update, but, even the Fed, they're even said there's going to be a mild recession. The U.S. Conference Board, I think they're projecting 3 quarters of negative growth starting in, I think, the last quarter of this year. And, you're going to have a recession coming up around the end of this year into next year. And 24 is an election year. So you're not only going to get rate cuts, you're probably going to get some fiscal on top of that if the recession is bad enough. So that's another thing. And then on top of that, yes, CPI inflation has come down, but it's all just been because of commodity prices. So you look at the other aspect, like core inflation, which, removes the volatile food and energy. So you're basically, the core inflation, you're basically taking out commodity prices, which are volatile and fluctuate. It's still at 5%, the core CPI. I mean, it's barely even moved. And we're in the second biggest tightening cycle ever, basically. And core inflation hasn't moved. Like you're only going to get core inflation down to 2% if you have a severe recession. Because if you have a severe recession, you're going to have unemployment going up. And then, there's going to be less spending and, those effects on inflation. Then you'll start to get, core inflation coming back down to where they want. But in that scenario, what happens? Boom. You have a significant recession, future easy spend. Yeah, spell check. I'm sorry about that. The worst recession, I mean, that's coming. And the other thing is there's no, a soft landing is impossible because if they want to say in 3 or 6 months, we have a soft landing, but core inflation, let's just say it's at 3.5% or 4%, what's going to happen? They'll cut rates, the economy will recover, commodity prices will go back up, and then inflation is going to go back up to 5, 6, 7% really quickly. So that's an ill-fated soft landing. So the Fed is approaching the point. I mean, not yet, but maybe in 3, 4, 5 months, where they're going to be between a rock and a hard place, where they're going to have to make a decision. Are we going to let there be a really significant recession, or are we going to tolerate a recession and we're going to try and come in the middle of that recession and, we'll cut rates and there's going to be some fiscal and, that's how we're going to handle it. I think that's more likely than, they're not going to tolerate. I mean, there's just election years coming and, recession will be a much bigger issue than inflation. So that's how I think it works out. But I think these are the reasons why gold is holding up really well. And look, gold could still go down to 1,700 or even, the 1,850, that target that I've been looking at. There's a lot of support. Metrics are pointing to that area. Even if gold comes down to those, it's still holding above the 38% retrace. I mean, you go back here. I mean, this is a very bullish consolidation. Even if it takes more time to break, this is holding up really well. I mean, it could go down here, and you could say it's still holding up really well. So, there you go. I know I'm babbling on a lot here, but these are my reasons. Let me know what your reasons are. And again, I know this doesn't help the miners, the juniors, or silver. It's once gold breaks out, we're in a new real bull market. That's when the rest of the sector will really catch up and really outperform.